sort of the trends I'm going to be keeping an eye out for in Toronto's housing market in 2023. That's what I'm going to be chatting about. My name is John Pasanos, president at Realosity Realty. You can catch all my latest writings on Toronto's housing market at movesmartly.com. If you have any questions specifically about buying, selling, navigating Toronto's housing market, you can set up a meeting with me at the link below, movesmartly.com/meetjohn, or send me an email at askjohn@movesmartly.com. So the start of the year, of course, is a good time where we often see lots of forecasts about what the future path of home prices are going to be in the year ahead. I don't do forecasts. I find it's a mug's game. These things are impossible to predict. If we look back at the past 3 years, during COVID, every peak and valley and plateau that we saw was completely unpredictable. I mean, the changes we saw in some cases, the market did the opposite of what all the experts thought was going to happen, especially if you think about the start of COVID. Everyone thought the market was going to tank, and then the market exploded during this time of complete uncertainty. So it's impossible to predict these things. I don't like predicting. I think what I like to do typically is just think about the potential outcomes, the most likely events that might happen, and then what are the factors that might lead to those events. So if we think about, a simple case where our three possible outcomes are home prices rising in 2023, home prices plateauing or roughly staying flat, or prices declining. Certainly the former, the first one, prices rising, is probably the lowest probability outcome. I don't think anyone is expecting prices to rise, or at least not rise meaningfully. I mean, I don't mean 1%. That's quite frankly just plateauing, but any meaningful increase, I don't think anyone is expecting. And I tend to agree with that. So the most likely outcomes for sure are either we're going to see a little bit more downward pressure, or a lot more downward pressure on prices, or potentially a plateauing in prices. So the key question is going to be, what are the different factors that might lead us down one path or another? And I think there are three broad things I'm going to be keeping an eye on in the housing market in the year ahead. And the first, of course, is, and I think most people should be keeping an eye, are the macroeconomic factors. And, for a lot of people, macroeconomics is not a fun subject, or not something people want to talk about. But it's certainly some things that we need to be familiar with. And I did a couple of videos, or at least one longer video, about how the economic conditions we're seeing today, are completely different from what we've seen in the past. And I think a lot of that was about talking about some of these factors. And certainly one of them was the high inflation rate we're seeing. And that is going to be a very big factor over the next year. The higher the inflation rate stays, the longer interest rates stay high, the more pressure we're going to see on the housing market, on house prices, and on households. And when we think about interest rates, they take some time to work their way through the economy. So the longer they stay high, the worse things could potentially become. So I think we need to be mindful and keeping an eye on what the path is for these things. I don't think any economist is expecting the Bank of Canada to make any changes to interest rates anytime soon. So that's not the bigger factor. I think the bigger factor is going to be what does inflation look like by the end of this year, because that's going to ultimately influence the path of interest rates a year from now. And I think those are some of the bigger things. And the other macro factors, of course, are potential recession, and most economists are expecting us to hit a recession. How deep is that? What are job losses like? Is going to be an important factor, because job losses and unemployment is usually sort of one of those big variables that tips the housing market from a slowdown to a crash. It's the loss in income. So that's going to be something important we're going to have to keep an eye on over the next 12 months to see what that looks like. I mean, right now it looks like if we hit a recession, it might be a technical one, maybe not severe, but these things can change at any time. I mean, it's impossible to predict these things, but I think we have to keep an eye on those. The second is, and we're hearing rumblings of this already, is financial distress from households. The higher, like I said, the longer rates stay high, the harder it is for some families that are very leveraged to basically maintain their current debt levels and keep their home and keep their investment properties, or keep whatever they have, all their debt is, at today's interest rates. And Some households are already feeling it. We're getting emails from people or consumers into my email account that we talk about on a monthly episode. We call the situation on here, who are trying to find ways to make their numbers work and to hold on. And we're starting to see, more people needs to sell their home. They're renewing, and this is the challenge. If you got a mortgage 5 years ago and you're renewing today and your mortgage payment was $2,500, it's going to go up to like $4,000 easily. And this is the massive payment shock that a lot of households are gonna have a hard time adjusting to. Now, the big question is not, will we see some distressed households or some distressed sellers? 100% we will. We're already seeing that. The question when we think about the impact it's going to have on the housing market is it going to be significant enough to cause downward pressure on prices, right? And if it is, where is this sort of potentially distress coming from? Is it uniform across the whole GTA? Usually that's not the case. Like usually, you might see it geographic and in certain areas more than others. Usually, the areas that will usually see a little bit more distress or more kind of forced selling before someone defaults on the property are usually kind of on the investment properties. A household's going to hang on to their principal residence as long as they can. The properties they're going to liquidate and unload to just get rid of some debt are usually their investment properties. So that can mean potentially condos, because there's a lot of investor-owned condominiums, or low-rise homes in areas that have a disproportionate number that are owned by investors who are just renting them out if they're over-leveraged. So this is one segment where I can keep an eye on. I don't know to what extent it's going to be a massive issue. Again, I don't think it's going to impact the most households. The mortgage insurers and I think the banks are trying to work with households to soften this payment shock. I mean, I think CMHC's already said they're allowing households to extend the amortization on their mortgage. So when they're up for renewal, if they had a 25-year mortgage 5 years ago, in theory, they should renew at 20 years now. Well, CMHC is allowing people to extend that out to 30 or 35 years potentially to lower those mortgage payments so they're not faced with this massive shock in their payments. So again, I think lenders and insurers are going to do that for most households, but the ones that are the most leveraged, I mean, they can't do anything about. And some of those households are going to kind of be pressured to sell. And potentially that might lead to more inventory and go in the market. And I didn't touch on this earlier, but it's important to remember that sales are going to remain low, most likely in 2023. So I don't think anyone's expecting a boom in demand, right? And this is why I think I and most people are sort of focusing on the listing side, because we're seeing sales being low almost as a given, because it's so hard to get a mortgage rate, a mortgage when you're being stress tested at 7+% when rates are this high, right? So I think most people's baseline, including mine, is that sales will remain very soft. So it's the listing volume that's going to ultimately impact sort of the future path and the direction that we go under. So I think that's going to be an important consideration. To what extent do we see more distress? I don't think it's going to be, quite frankly, I don't think the biggest risk is this year. My bigger concern, quite frankly, is 2024, because like I said, people will hang on as long as they can. People just do whatever they can to hold on. It's when rates stay this high for a long time where things start breaking and people can't afford. So I think the longer we go, it is kind of when the risks are greater, which in some ways is the opposite of what some economists are forecasting. I mean, I can't remember which one it was. One bank, I think it was maybe TD, was predicting that the first half of this year would be the bottom and for the housing market, which might be true. But again, I'm more concerned about the stress on households over the longer term, not so much the next 6 months. And the third thing I'm going to be keeping an eye on is the pre-construction condo market. We've seen a ton of headlines, of course, of a massive number of completions scheduled for this year, over 30,000. I mean, whether there are actually 30,000, I mean, is kind of irrelevant. Even if it's 25 or 20, it doesn't make a big difference, because the bigger issue right now is that, there's actually two issues. Number one is anyone who bought a pre-construction condo after 2020 or in 2021, like over the past few years. So either a condo that was a smaller building with a shorter development timeline or construction timeline, or a bigger building that started construction in 2018, but they bought a little bit later. Some of those people are going to be faced with a situation where the price of the unit that they bought isn't worth what they paid for it. So there's going to be a gap there that they have to cover the difference. So they paid, $900,000 for a pre-construction condo, but by the time it's completed, the bank says it's only worth $850 or $800. And I say that timeline because it's the people who bought in the past year or two or three who kind of paid sort of these very, very high prices for pre-construction condominiums. And especially with resale prices falling, there might be not enough appreciation there for them to have made some money or even break even on that transaction. Whereas if you bought in 2017 or 2018, those investors have very minimal risk in terms of the value because the condo's gone up. Even with resale prices down right now, those investors have probably made money. So the first is certainly the risk of the people who bought recently who are going to have a hard time closing. The second is no matter when you bought, some investors are going to have a hard time closing just because they can't get a mortgage, right? And again, I think the sophisticated investors who know what they're doing are going to have no problem closing. They have the capital, they have the money, they're going to be fine. But there's some who treated pre-construction condos as like a lottery ticket and probably just went up and put deposits on more than they should have and leveraged themselves and took out a HELOC from their home. And people who are just and probably some people who are just expecting to be able to flip them before taking possession. Those investors are going to have a hard time because they're not going to be able to get a mortgage potentially, and they may be backing out or defaulting on their transaction. Now, again, is this going to have a massive ripple effect? It's hard to say. My instinct is unlikely because what happens in at least in the short term, what happens in the pre-con market, we'll have to see if it spills over into the resale market because, there's not a lot of transparency on how many buyers are going to back out, what the builder is going to do with those units. Are they just going to hold them and rent them or resell them? So the prices and everything that goes on sort of in the assignment market before the owner actually takes possession isn't transparent or isn't very clear. So it may not spill over into the resale market, but we'll see. At the end of the day, there is some risk there. And then the other risk, of course, is that even if buyers, the investors can get a mortgage and they close on it, the challenge is that a lot of these investors, of course, are going to be paying 5+% on their mortgage payment. And the numbers on the investment properties don't work as well. If you only have a 20% down payment, you're going to be bleeding cash every month. And while most investors in the past were fine, having being cash flow negative, meaning that the rent doesn't cover their mortgage payment and their property taxes and their maintenance fees. But that gap is going to be a lot bigger today. And it's going to be probably a harder pill to swallow for some investors, especially if they don't expect prices to rise very much anytime in the next 2-3 years. We're not expecting a lot of price growth. So it'll be interesting to see if some of those investors, even if they take possession, end up trying to unload them on the resale market after they got their keys, after they took ownership, because they just don't want to be losing, $1,500 or $2,000 a month out of their own pocket to carry a condominium. So those are some of the things that I'm going to be keeping an eye on, obviously, as we move through the year. If the data changes, if anything changes, those are the things we're going to be talking about, and new issues I'm sure are going to come up that we're going to be talking about. But if you have any questions about these ones, please post them in the comments below or send me an email at askjohn@movesmartly.com.